Why was your mortgage denied? That's the topic for today's episode, and without further ado, let's dive in. Hello everyone, and welcome back to another episode. So today we're going to talk about the debt to income ratio and how much of it can impact the approval of your mortgage. So I'm sure you've heard about stories of people who have a 800 credit and then all of a sudden they go to the bank and they apply for a mortgage and they got denied. And then for no reason, you are the kind of person who maybe has a 650 credit. You go to the bank and all of a sudden you miraculously got approved a mortgage application. So that actually happens to me a couple of years ago. My very first mortgage, I actually got that approved with a 620 credit. And then when you fast forward a couple of years, I started making more money, and then all of a sudden my credit was, well, not great, but I thought it was great. It was at a 750, and all of a sudden I got denied that mortgage. So I didn't really know exactly why that was happening until I started getting a hang of it. I started talking to a couple of mortgage brokers and they were on a quest to educate me. And this is in essence what it really happens. So let's say, for example, you have this column right here, right? So you have your assets and you have your liabilities. Some lender, they call this the personal financial statements. Some of them call it the debt to income ratio. Some lenders even call it the net worth statement. So they're all meant the same thing, potato, potato, right? And in essence, that translates to how well are you managing your money overall and whether you're gonna have money at the end of the day to cover the mortgage payments, right? So let's say, for example, a typical financial statement, a personal financial statement will look like this. So you have your cash, and by cash, they typically refer to your salary, your checking accounts, your savings. They want to know whether you have any stocks, whether you have any, let's say, for example, real estate available and stuff like that, and whether you have, let's say, any life insurance with cash accumulation. And then on the other side, they want to know how much of that money that you have here on the asset column is going towards any debt that you have. So for example, you have a mortgage, let's say, for example, right? And then you have credit card 1, you have credit card 2, and you also have a personal loan that you took out in order to bring your credit card debt down in order to bring the credit score up here, right? So let's say these are your categories. And so let's assume we're filling this up for you and you're filling it up with, let's say you have $3,000 as cash, salary, whatever. And then you also have a total of $3,000 worth of stock investments and stuff like that. And you have real estate. Let's say, for example, you have paid down the mortgage and you manage to accumulate, I'm just going to throw a number out there, $2,000 in real estate equity now, and you have accumulated about $1,000 in life insurance cash accumulation. So the numbers that they are looking to see are actually monthly numbers. So what you're going to put down here is the monthly salary, whatever you have on that particular month that you're applying for the mortgage. And all of this, let's say it's adding up to $9,000. So you have $9,000 right here. And on this side of the column, it is very important how you actually fill this part up, because this section right here can either make or break your mortgage. And this is what it did to me. So for example, let's say coming on this side of the board, you have your mortgage and your minimum payment is $1,300 every month, right? Let's say you have this credit card right here, and all of a sudden your minimum payment is $150 in this one. And you have another car and your minimum payment is only $50 because you owe less money. And maybe in your personal loan, what you own is a total of $200, right? When you add all of these numbers combined, so we'll have $1,300 plus $200, that's $15. So $1,700, right? So you have $1,700 and liabilities that you have to pay. You are required to pay as by law because that is your minimum payment. But if you are like me and like most people, you don't want to just pay the minimum payment. What you want to do is just to pay extra on top of whatever is required so you can reduce your debt and therefore reduce some type of interest payments as well along the way. So I was paying, let's say, an additional $200 here. I was adding an extra $100 here, and I was adding an extra $100 here. And because this payment was high, I was actually doubling the minimum payment. So I had $200 over here. So in total, I was adding to my minimum payment $200, $300, $400, $500, $600 in total. And guess what's going to happen? So these two numbers combined, they add up to $2,300. So we have $2,300 right here and total debt. That was my total liability for that 1 month. Look at what happens to your debt to income ratio. And this is where things went wrong, right? So I use the total amount, the minimum plus everything else I was paying on top of that. And when you divide this number, 2,300 divided by 9,000, it gives you a debt to income ratio of 25%. But what happens if I were to take only the minimum payment, which is 1,700 divided by 9,000? So when you do that, I need to get my calculator right here just to be safe. And I just realized this is actually a 26%. And when you divide 1,700 divided by 9,000, it gives you a debt to income ratio of 19%. Obviously, these are just illustration, but look at what happens. Who do you think the bank is going to favor more? Whoever has a debt to income ratio of 19, meaning you have less liability, or someone who actually has a debt to income ratio of 26? Now, each bank has different requirements, so don't quote me on these 20 versus 19%. Some banks are okay with lending you money when you have a 40% debt to income ratio. Some of them can push it a little bit and they're okay with lending you at a 50%, but obviously they're going to charge you more interest. But in essence, if they, let's say for example, they have 2 mortgages left to issue on that 1 month, let's say you come in at the end of the month, who do you think they are going to issue that mortgage to? The person who only owns 19% or the person that owns 26%? Obviously, they're going to go with the person that has the least amount of debt, because that means this person has a higher likelihood of making those mortgage payments versus you, who is sort of trying to manage the debt. So in essence, how you fill out this part is actually very important, because you are really required to include this amount, the minimum payment. And that's gonna make you look richer in paper, so to speak. You have less liabilities to worry about, therefore you have more money to pay them, because at the end of the day, all the bank cares about is that you make the mortgage payments. They're not in business to do real estate, they're in business to make money. So I didn't know this until a broker actually walk me throughout the entire process. You're not lying, for those who are kind of like wondering, well, isn't that like misleading? You are required to put this down. You're not required to pay an additional $600. You have the option to make any additional payments, and you're choosing to pay $600. But let's say for that 1 month where you have that mortgage, you decided to not pay, but you cannot go away with not paying the $1,700. You have to pay the $1,700. You are okay if you don't pay $2,300. So this is what, in essence, kind of like got in the way during my mortgage application. So having a 750 credit wasn't really enough, because I could not prove that I knew how to manage my debt efficiently. So that was a lesson learned. And what did I do? I just went to another lender. I applied for a mortgage with my 750 credit. And this time I was smarter around, thanks to the educational session that the mortgage broker gave me. And instead of including whatever was in this amount, I decided to not include that, because by law, I'm only required to pay this much. And that brought my debt to income ratio super low. And it, in essence, it helped me qualify for the mortgage. And that's basically everything I had for you guys today. I hope you found the information valuable and helpful. And as usual, if you know of somebody who is going to benefit from this information, feel free to share the love by sending the video and hopefully help them learn something new. And don't forget to hit the like button and subscribe. And for the ones who are actually interested in real estate mentorship, feel free to visit the website right here in the link, or just send me an email directly so we can schedule a strategy session for you. And until then, I'll see you guys next time. Take care. Bye-bye.